Once again, ladies and gentlemen, this is the Investor Show. As always, this is your host, Prince Dykes, the Prince of Investing, coming to you guys and girls live all the way from the beautiful state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. If you got questions, drop comments below. And if you like the video, don't forget to give it a thumbs up. And if you don't like the video, give it a thumbs up anyway and share it with your friends. But as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So in this video, as you can see in the description box, we're going to talk about covered calls and how to buy them with TD Ameritrade. So we're going to talk about what they kind of are a little bit as we walk through it. So if you don't know what it is, stay tuned. We're going to walk all the way through placing the fake covered calls, not a fake one, but I'm going to walk you all the way through the whole process, telling you what everything means, and hopefully you get something out of it. But here, so you're going to go up to the trade first, right? Trade right up on the options. You're going to go to covered calls, right? And it's going to bring you to this screen here. So the first thing you're going to do is make sure I'm on the right one. We're going to go to your cover calls, right? Now you're on your cover calls, and we're going to go to right here. It has the option strategy. Obviously, it's a cover call. So we're going to go type in Google, just for example. I'm going to just use that one. Then right up under that, you can go to option. You can look at the options chain as well. This will tell you the bid and the ask, the strike. You can use that if you want it. We're going to use Google, and it says how many do you want to do, right? So you got to think about it. In a contract, in the United States contract, how many shares in a contract? 100, right? So 100 shares equals one contract. So you're going to buy 100 shares of Google. That's what you're going to do. And what you're going to do after that is now you're going to have to sell open one contract because, if you put two here, if you put 200, you see how it turns to two? So 100 shares is what you call it, right? 100 shares. So now you're going to go to the expiration date. What expiration date you want? We're just going to put August 24. And now you're going to pick the strike price. The strike price is, hey, whatever the price you want it to be. This is the expiration date. This is when this contract is going to expire. Because what you're going to do is you are buying 100 shares of Google, and then you're going to sell open. You're going to sell a contract to open one for one contract that's going to expire on August 24th. And the strike price is the price that you're saying, hey, that just call it like right now. Google is at $112, right? I'm $118. So let you say you put your strike at 130, right? You're saying I bet the strike, that the price of Google won't be at this price by this expiration date, right? So here you have an order type, net debit. A debit is money that's going out of your money is. Why am I keep getting text messages? I gotta turn my phone off. I'm sorry about that. You see, I gotta say my phone just keep going crazy. But what happens is a net debit is money that is coming into money is going out of your account is net debit. Money that's coming into your account is called a net credit. So this is a net debit. You can put in here a premium that you want to do, a price that you want to put or whatnot. Or you can just go down here and just put market. Give me the best price that's available, right? So we're going to walk through this. Bam. We're going to hit receive, right? So this is going to walk you through your particular order. And what I mean by walking through your order is saying you're going to buy 100 shares of Google, right? And you're going to sell one contract, right, by the day. So over here, 100 shares of Google, when you look over here, or positions of value of Google, 100 shares of Google costs you $121,000. That's what you're going to have to put out, right? Then, but you're going to take in, right here, your estimate after trade, you're going to take in $1,100 because you sold a Google. You sold a call. Once you sell the call, you're going to take that money, right? This position becomes valuable is if the position expires worthless. So say if you buy this, the price of Google doesn't really go up. It doesn't reach that strike price. The person let it expire worthless. You get to keep the $1,100. That's why people can do this. But if the strike price if it goes down or whatnot, if the stock goes down or whatnot, you can lose value off of the stock. But that call is not going to probably be worth it. The person's not going to execute. But if the price of the stock goes up, the person could call away, which means that you can lose your shares. A person could execute. Let's say by this expiration date of August 24th, let's say the stock price goes up to $1,250. A person may want to execute because they can buy them from you for cheaper than they can off the open market. Hope that don't sound too confusing. But this is a way people, you can make money off of buying a stock. You can buy a stock and collect premium. So when you hear people say collect premium, the sellers are the ones who win in the option trading world that I've seen. So that's like statistically proven. So hopefully that helps you out. All right. So, and when you go here, you hit place order. But anyway, don't forget to hit that like, subscribe, comment, and share button. And if you got more comments, drop them below. And follow us on our other platform in the description box, the podcast, Facebook, Instagram, Twitter, all that good stuff like that. But until the next video, cartoon, or whatever you see me do crazy around the globe, peace, be safe. I'm out. Thank you.